a rumor, an actual failure, and all of a sudden you don't trust anybody. You're getting all your money out of all the banks. And again, this is actually a regulator's worst fear.
Jim Rickards warns about the dangers of AI-driven market crashes and bank runs. He explains that AI, with its speed and scale, amplifies financial panics, causing markets to crash faster and more severely than in the past. Previously, human market makers could stabilize markets during downturns. But now, AI algorithms lack the judgment to take the opposite side in a panic. He uses Silicon Valley Bank's recent collapse as an example of how quickly digital bank runs can happen, with billions moving via smartphones before regulators can respond. Rickards argues that while AI works as designed, it can unintentionally create dangerous consequences by intensifying panics across the financial system.
So apply that to capital markets. So let's say a market crash happens, and we'll in a separate discussion we talk about how that might actually be caused by AI, how AI can be used by intelligence services, market manipulators, and others to actually trigger a crash. But leaving that to one side for the moment, let's say the crash begins. What's the most sensible thing to do? Well, for a lot of people, we'll lived through enough crashes in recent years, kind of sell everything, go to cash, move to the sidelines, wait it out. And then when it settles in, all right, maybe tiptoe back into the markets, buy some bargains, et cetera, and off it goes, going up again. That's a very smart strategy for an individual. But again, what happens when everybody, all of a sudden, they're all sellers, no buyers, the market's going to zero, you're blowing through circuit breakers, you're closing the markets, et cetera. And I talk about that in the book. So what's the remedy for that? It's human nature, but I'm basically saying that we're talking about human nature amplified and accelerated by AI. So the idea of a market panic has been around, the 14th century, the fall of the houses of Bardi and Peruzzi in Florence. I mean, that's 800 years ago. So nothing new about panics. But what is new is the speed at which they can happen, the amplifying effect, and the recursive function, what people call feedback loop, that results from AI. Now, here's the problem. So, well, can't you design AI that, if we're supposed to mimic humans, there are humans out there who kind of see things going down and say, well, that's a good time to nibble, a good time to get in, et cetera. But all these algorithms, and here you really have to, you're talking about taking developers and scientists on the one hand and market participants on the other, mashing them up because you're creating systems that are going to be used in the markets. They don't actually think that way. All these algorithms are the same. You'd like to think mine's unique or mine's smarter than somebody else's, whatever. They're not. They're basic. I know how they work. I built them myself. I built them for the U.S. intelligence community. I built them in capital markets. You're using a lot of information. You're using things that you might learn in business school. You learn on Wall Street. You learn through experience. There's a lot of mathematical theory behind the optimal way to work in capital markets. But that's the point. Everyone's working off the same ideas. And so these programs, no matter how sophisticated they are, they all kind of work the same. And you go back to the old days on the New York Stock Exchange. Now I'm talking about the 70s and the 80s. This has been kind of long gone. But there was a participant called the specialist, and the specialist was given privileges. One of the privileges was you made the market in a certain stock. You'd have might be American Airlines or ExxonMobil, whatever it was. You were the market maker in that stock. And you got to see the back of the book, which was not transparent at the time. But in exchange for those privileges, you had some duties and responsibilities. And you were supposed to a point anyway, stand up to the market. When there was a wave of sellers, you were supposed to be a buyer, try to kind of, equilibrate the market. Or if there's a stampede of buyers, you might be a seller to try to provide that liquidity. That was your job. Well, that system's long gone. I talked to the head of operations on the stock exchange. We were down on the floor. He said to me, Jim, don't think for 1 minute there's any liquidity on this floor, because there isn't. And I understand that. But what we have instead are computers, and AI in particular, and there's no one to perform that old common sense human function of taking the other side of the market. When the sell trigger happens, and it does happen in a panic where it can be manipulated, all the algorithms are going to say sell, sell, sell. There are going to be no buyers. Markets are going to go straight down. They're going to hit circuit breakers, close them for 15 minutes, boom, hit the next circuit breaker. And they're going to end up, and I talk about this in the book, actually closing the markets. There comes a time when the circuit breakers don't work. The losses are too great. We're talking multiple trillions of dollars of losses. The panic is too embedded. There are no specialists. There are no, kind of Whitneys to walk around the floor and say, I'll buy some. Because we've handed it over to AI, and AI has no common sense. It has algorithm, but that's it. And the other point I make is that as humans, we tend to anthropomorphize our system. So I'm sure we've all had encounters with Siri and Alexa, and there are others. Google has one, and they talk to us. Actually, a pretty pleasant voice. And so you almost develop a friendship with your computer. It's like, hey Jim, what do you want? What do you want the lights to be? Or dim them down a little bit or turn them up. Or you're talking to this computer, but we tend to think of them as humans. They're not. They may have pleasant sounding synthetic voices. It's pure math. When you know how it works and you dig in, it's just math and a huge database. So they're not our friends. They're not human. They're actually not intelligent. We call it artificial intelligence. The artificial part's true. They're not really intelligent in the way that humans are, because humans have a lot of intuition and common sense that no one's been able to program. I mean, you can program a lot of what we're talking about, and they do, but they can program those more noetic, intuitive elements. And so we're anthropomorphizing it. We're treating them as friends. We're treating them like humans. We're relying on it. It is very powerful. I don't doubt that. And again, to my point, it's not that it's going to malfunction. It's going to work exactly as intended, but most people don't understand what that means. Well, we just talked about capital markets and stock markets, and that is the danger. And again, I make the point, and you said the same thing, Bernard, that panics can happen on their own for no particular reason. When they happen, you look back and say, well, it was this or that fund or whatever, but that's more of a symptom than a cause. They just kind of fall in on themselves, and AI will amplify that. But when you combine it with market manipulation, someone who's very sophisticated in AI, who understands what we're talking about and what I describe in the book, who says, got it, I'm not going to take that and use it to my advantage in criminal or manipulative ways, and then leaving aside the greed factor, people trying to cause a market panic, but front run the panic in a way that they make a lot of money and just get away with it. They're also, again, it's a weapon. We don't have to, necessarily spend a lot of time on financial warfare. I facilitated the first ever financial war game done by the Pentagon. They did not need my help with, missiles and bombs and things like that, but I was tapped as a financial capital markets expert to help design a financial war game, and we did. This is before AI has been around since the 50s, or you can go back to Aristotle if you want to. But we worked at a weapons laboratory between Baltimore and Washington and did that. So I have a lot of experience in financial warfare. But when you say, well, it's not just market manipulators, but intelligence services and political enemies who are trying to do us harm. I mean, what's the point? Go back to World War II, or Vietnam War, where there were all these bombing raids. Well, why were they bombing the enemy? Well, you were trying to destroy their industrial infrastructure. You were trying to destroy railroads, manufacturing plants, weapons facilities, coal mines, natural resources, pipelines, whatever it was. That's what you were doing with all the bombs and the aircraft. Well, what if you could do that with computers, which you can? What if you can do it by disrupting financial markets? If you can destroy an economy through digital financial warfare, who needs bombs? Because that's your objective at the end of the day. So now take your market manipulators, and they've always been around, and your political enemies, and they've been around, and AI, so make it a tool that the bad guys can use, to put it that way, combined with human nature and all the dynamics we've been talking about. And this is a very dangerous situation. And I'm not saying get rid of AI. What I'm saying is beware of the dangers. And there are some solutions. I don't write books where I point out all these bad things and then leave the reader hanging. I offer some solutions in there in the books as well. But to your point, where else does this apply? Well, then I pivot to the banking system. And as chapter 2, the banking system is very different than capital markets. I mean, you might have the same firm doing both. I started my career at Citibank at a time when there was a strict, Glass-Steagall divided commercial banking and investment banking. That's all gone. They're all mushed up. But they could be in the same institution, whether it's Citi or Morgan Stanley or Goldman or Wells Fargo, et cetera. But they are different activities. So looking at the banking system, what's the equivalent of a market meltdown? What's a run on the bank? And again, we've all seen the grainy black and white photos of the 1930s. Banks are failing, and mostly men. Some women are in overcoats and fedoras lined up around the block in the rain, trying to get in the door and get their money out before the bank shuts their doors. And usually you didn't make it. because the insiders had already taken their money. So that's a good old-fashioned run on the bank. Today, the same phenomenon, the same dynamic applies, except you just get your iPhone and move $1 billion with a couple passwords. Boom, it's out. And you text your friends in the process, which is exactly what happened with Silicon Valley Bank. I mean, that didn't work out over weeks and months. I mean, that happened in 2 days. $100 billion went out the door, and it wasn't all mom and pop depositors. Over 95% of the deposits at Silicon Valley Bank were not FDIC insured. FDIC insurance goes up to $250,000, but there were major Silicon Valley firms and actually crypto exchanges that were swapping crypto for dollars and had dollar balances in Silicon Valley Bank, $3-4 billion each, and that's the money that was heading for the exits. And then people were texting their friends, other entrepreneurs, other businessmen, hey, get your money out fast. Well, so that kind of digital communication and AI working together accelerate the bank run phenomena so that the regulators are almost the last to know, and it's almost over. So we go into that as well and talk about how that is also, again, subject to manipulation, but it doesn't have to be manipulation. That makes it worse. It's just human nature, a rumor, an actual failure, and all of a sudden you don't trust anybody. You're getting all your money out of all the banks. And again, this is actually a regulator's worst fear. Stock market crash is pretty bad. And the one I describe in the book would be the worst you've ever seen because they actually closed the markets in the scenario I give. But you can recover from that one way or the other. It's just enormously costly and disruptive. Banks are different. Banks are actually where money is created. Everyone thinks the Fed creates money. The Fed's printing money. The Fed's printing money, $10 trillion. It's really smoke and mirrors. I mean, the Fed does create a certain kind of money. They call it M0. It's base money. And the way they do it is they buy bonds from dealers. So Federal Reserve, and I used to work for one of the so-called primary dealers. We did this. The Federal Reserve calls up a primary dealer and says, offer me, $1 billion of 10-year notes. And they offer you a price, say done. And the dealer sends the notes to the Fed, and the Fed pays for it with money that comes out of thin air. So that much is true. The money does come out of thin air. The question is, what do the banks do with the money? They take it and they give it back to the Fed in the form of a deposit at the Fed in your account at the Fed, and they're called excess reserves, and they're now in the tens of trillions of dollars. In other words, that money doesn't go anywhere. It is created. It is a ledger. But all the Fed is doing, they're expanding the assets in terms of bonds, and they're expanding the liability in terms of deposits. But this money is not going anywhere. It's not in circulation. It's not produced right. The money that does matter, the money that drives the economy, that can cause inflation or bubbles or just be very productive, a good form of money, comes from the banks, not from the Federal Reserve. So when you start shutting down banks and they get into a domino-style sequential collapse, that's the Fed's worst nightmare. Not so much we're losing in the stock market, but the banks are collapsing. And then again, what's the equivalent of closing the market if you have a stock market meltdown? Well, nationalizing the banks. That's what you have to do. So I'm giving extreme cases, but I'm making the point that the phenomena of a market crash or a bank run is not new. What is new is the amplifying effect of AI, the fact that it happens faster, that it feeds on itself because AI lacks nuance. It lacks the ability to say, man, maybe this bank's okay. No, they just get out of all of them all at once. And so that's another danger. It's an explanation. I did a ton of research, very detailed explanation of what can go wrong. So I'm not saying get rid of it or ban it or it doesn't work, et cetera. Actually, I make the point. It's almost never the case that it doesn't work. It actually works exactly as it's intended. It works very well. But the problem is the things that the developers can't see. Unintended consequences is one way to think about it. But on a sort of broader plane, things that make sense for an individual bank or an individual hedge fund or an individual application, et cetera, might be extremely dangerous when scaled up to include all the players on the scene. This is something, the idea, goes back to, any banking panic, but certainly, John Maynard Keynes and others. It's called the fallacy of composition. That's the technical term. But what it means is that something that may make perfect sense for an individual or a small group is dangerous and destructive when applied on a large scale. Very simple example. By the way, some of these, I look at, I kind of deal at the PhD level in economics, but I've yet to find an idea that can't be expressed in plain English if you just take the time to do that. So an example a lot of people will be familiar with, you're at a football game or a baseball game, and one fan decides, well, I'm going to stand up to get a better view. And they stand up and they do get a better view. That actually works. The problem is the person behind them stands up and so on. Next thing you know, the entire stadium is on their feet and nobody has a better view because they're all in each other's way, exactly the way they were when they were sitting down, except everybody's standing a little bit uncomfortable. I mean, unless it's a close game or something. But the point is something that makes sense for an individual. I'll stand up and get a better view. That's actually true. But what it leads is to a cascade where everyone's discommoded, everyone's doing the same thing. Nobody's better off.
In conclusion, Jim Rickards urges caution with the increasing role of AI in financial markets. While AI brings efficiency, it also accelerates and amplifies risks, making the financial system more vulnerable to sudden panics. As we move forward, it's crucial to understand both the power and potential pitfalls of AI, especially when it comes to our money. Awareness, regulation, and a balanced approach could help ensure that these technologies serve us safely and effectively. Stay informed, stay prepared, and make decisions with caution in this rapidly evolving financial landscape.